Thank you very much, Margaret, for the kind introduction. Thank you to Joe for inviting me, and welcome. Good afternoon, ladies and gentlemen. And it's a great pleasure to be here with you at this summer school, very prestigious, interesting event. Your invitation encouraged me to come to Donegal, do a few days of hill walking, and managed to make the top of Slieve League, if I pronounced that right. So it's nice to see a bit more of Ireland. I've only been here for 18 months, so it's been a pleasure to be in the county. My top priority during those 18 months in Ireland, as you imagine, has been dealing with the banking system. So what I thought I'd do today is give you a bit of detail about the different work streams that we've got on the banking strategy as a central bank, some stuff from ourselves, some elements from the financial measures program. That's the official title for the banking part of the program with the IMF, the ECB, and the EU. And what I want to do is, in this short presentation, 20-25 minutes, touch on 5 areas very briefly. The capital story, if you like, what's being done to strengthen the banks financially. There's important news about that this morning. The deleveraging story, or how the banks are going to be restructured, as I explained. There's a lot of hard work still to come on that. Talk about our new rules on corporate governance and fitness and probity for directors and senior people in the financial services industry. Give you some recent thoughts on the need to set new standards on managing credit risk. And finally, talk a little bit about changes we're doing to improve how we do supervision at the central bank and learn the lessons of the financial crisis. That's quite a big agenda for 20 minutes, so I'll be brief. But I want to give you a flavor, if you like, for the interconnected nature of that work program. Different work streams are going faster. Some are going to take some years. And I want to give you a sense of the scale of the challenges. So let's start with capital and the financial strength of the banks. And the immediate challenge of rebuilding the banking system is involved in a number of interconnected exercises under this financial measures program aimed at strengthening the capital position of the banks. And these included an independent loan loss forecast exercise and stress tests, which were carried out early this year. And off the back of that, we could establish how much capital the banks needed under what we call our PCAR, or Prudential Capital Assessment Review. Now, our PCAR this year took place against a very difficult background. There's the severe crisis in the euro sovereign debt markets, weak Irish economy, the formal EU IMF program for Ireland, and fundamentally, and perhaps most importantly, a lack of market confidence in the Irish banking system. And you see that in their wholesale funding position. I'll talk a bit more about that, and particularly concerns about how bad is it going to get? How bad are those levels of loan losses out there? So against that background, we took a very conservative approach to our stress test. We had a very conservative assessment of loan losses. We built in an additional capital buffer afterwards, and we built in a lot of transparency, and we used external parties to assist us and to have confidence in the outcomes. In terms of that external validation, the stress tests were not only informed by the views of the banks themselves, but also by a fully independent assessment of portfolio losses conducted by BlackRock, a very large US firm, well known for asset management. And the data inputs for those exercises were themselves subject to independent assessment. And then overall, the whole process was subject to a quality assurance exercise by ourselves and Boston Consulting. On top of that, the results of the stress test were checked by the IMF, the ECB, and the European Commission. So by any measure, we've had a very thorough process of looking at the losses and the risks in the bank's books. In terms of transparency, we have a detailed 80-page assessment. It's available on our website. We give a breakdown of loan losses under a base scenario, a stress scenario, a lifetime scenario, the bank's views, the BlackRock views, mortgage, corporate, SME, personal lending, other, very broken down. I'd say the most transparent results of any stress test you'll see any regulator doing. And the goal of that transparency was straightforward. We wanted to address that market skepticism about the bank's financial position, about being completely open about the results of the process, so that market participants themselves can make an independent judgment about the conclusions of the exercise. Now recently in June, we published a report on our banking supervision strategy, And we gave a view on something that's closely related to capital. I just want to spend a couple of minutes on that, and that is the bank's accounting or provisioning for loan losses. What our PCAR exercise did was focus on ensuring adequate regulatory capital. So there's enough regulatory capital in place for any losses in their loan books. But this exercise didn't directly relate to the bank's accounting for such loan losses, which should normally occur in their provisionings under international accounting standards. IFRS is the term of art for that. What we feel it's important to close the gap, if you like, between the regulatory capital assessment, which is now conservative, and what you're seeing in the bank's own accounts. So we think there should be further measures put in place to ensure the bank's balance sheets more accurately reflect in their accounts the underlying risks. So we've therefore decided to require the banks to make a number of new disclosures designed to align the provisions they have with the underlying facts of their balance sheets and their portfolios. And we're going to oblige the banks to ensure that potential impairment from future disposals, from sale of non-core assets, I'll talk about that, is recognized as fully and as early as possible. Now, in determining the capital needs of the banks, we assessed their residential mortgage portfolios. And what I thought I'd do is just spend a brief moment to digress from capital for a second to talk about this difficult issue of mortgage arrears. Now, I recognize the stress and anxiety that mortgage arrears, or even the imminent threat of mortgage arrears, is having on the day-to-day lives of many Irish people. On the 1st of January this year, we introduced a revised Code of Conduct on mortgage arrears. And the code, and we have a consumer guide about that's available on our website. This code changes the way all mortgage lenders must treat customers who are in arrears or pre-arrears, and aims to take away the fear factor that a borrower might have when talking with their lender. At the heart of the revised code is a requirement that all mortgage lenders establish a mortgage arrears resolution process, or MARP, and that has to contain a number of key elements. Every mortgage lender's process must include better communication with borrowers. They have to set out a schedule of what types of debt restructuring they might be offering, rescheduling and restructuring they might be offering. A standard financial statement used for all customers to gather information to make judgments. And has to be an assessment process that considers all the borrower's circumstances in a centralized way through a standard arrears support unit. And there has to be different resolution options presented to the customer. And then there is an appeals process so the borrower, if they're concerned, can appeal the decision. So this MARP framework is aimed at ensuring a more consistent, a more transparent approach by lenders when dealing with their arrears cases. In addition, in the code, we've included a requirement that legal action, such as repossession, cannot be taken against borrowers as long as they adhere to the arrangements they have with their lender. Now, this is a key measure, and it gives, if you like, time and space for borrowers to deal with their difficulties. The code also ensures that borrowers in financial difficulties cannot be required to change from an existing tracker mortgage to another type of mortgage as part of the move to a new payment schedule. We also put a limit on the number of unsolicited communications a lender can make to a borrower, because we feel that just adds to the pressure under very difficult circumstances that the borrower and customer in arrears always feels. And then from January this year, we've prohibited lenders from applying certain charges on mortgage accounts which are in arrears. Now that the banks are being conservatively capitalized, they'll have more capacity to restructure the debts of their mortgage or small business customers. But there are a couple of caveats. The PCAR exercise has, by some measures, been to overcapitalize the banks. So the expectation is that at some point, when the banking conditions settle down sufficiently, the taxpayer will wish to recover some of that capital, for example, to assist the overall government debt position in due course, to take back the capital out of the banks. Also, any approach to restructuring needs to take account of the risk that it creates incentives for borrowers to cease meeting their obligations. But, despite these considerations, there is now more scope for the banks to take individual decisions based on the particular circumstances of the borrower to restructure debt. and I'm encouraged by the government's commitment to reforming the antiquated bankruptcy laws. Allowing a statutory but non-judicial debt settlement mechanism would be a welcome reform and allow borrowers to earn a fresh start by discharging their debt after a reasonable period. The treatment of customers in mortgage arrears and compliance by mortgage lenders with the code forms a key part of our consumer protection agenda, but it's important to point out that our focus on arrears is not just to mortgage arrears. We have a review of our consumer protection code, and we've proposed a new requirement for arrears for other types of non-mortgage debt. These will, for example, similarly prevent harassing behavior by banks for the non-mortgage debt as well. And we plan to finalize the revised code in the autumn following a consultation over the summer. We're also considering what protections to put in place to help small companies who may be viable but who currently have arrears on their existing loans. So to facilitate an arrears resolution between SME borrowers and lenders, we've brought forward a review of our existing code of conduct for business lending to small and medium enterprises. Now, before I leave capital and move on to deleveraging, it's probably worth just noting that announcement this morning of the investment from an outside group of investors into the Bank of Ireland. I just want to say that I think that's very encouraging, encouraging on a number of fronts. It means that one of the key pillar banks will not be in government control. It means that the taxpayer saves a considerable amount of money that would have to be injected. It shows, if you like, the private sector putting their money into Ireland, into the Irish banking system. I think that's very encouraging. And I think it also shows, if you like, an endorsement by private investors, at least some, about that capital assessment I've talked about. And if you read the announcement today, it's a straight capital investment. The investors haven't said, we'll put money in, but we want you to backstop us on risk. That if the risks are worse than the PCAR, we expect you to stand there. The government's not there providing any sort of a guarantee type of facility or backstop. So I think that's quite encouraging that you have private capital showing that the losses are more clearly defined, and if you like, that link between the sovereign's debt position and the banks is being broken slowly but surely. So the second big challenge, second big work stream is about deleveraging. So this is aimed at correcting the funding positions of the banks, and in turn involves their restructuring. And this is a large part of the story of a steady process of deleveraging the banking system. Loan losses and credit quality is only half of the problem of restructuring the Irish banking system. The other half of the problem is the funding position of the banks, which in turn is linked to their structure. So just to give an example, to go off my text for a second, if you think about capital, about credit losses, bad loans were given, and you have to plug those holes, what we're talking about here is the banks just getting too big, right? So if you look at the 2-year period before the financial crisis in 2006, the banks themselves were borrowing from the wholesale market something like 145 billion euro. So this is money from overseas, from other banks, from wholesale depositors, and they're just getting bigger and bigger and bigger, and then lending that money into the Irish economy, into the banking sector. What's happened in the past 2 years is that money has run out of the system, basically. The wholesale funds have left the system because of the credit ratings, because of the sovereign's position, and because of the weakness of the banks and the uncertainty, and that's had to be supplanted by funding from the European Central Bank and the Central Bank of Ireland. So it's not just about the credit risk issues. A big challenge I'm going to talk about now is about that funding, about the banks getting too big and needing to deleverage down in size so they can stand on their own without having to go back to the wholesale markets or without having to rely on the ECB or the Central Bank of Ireland. So we had a parallel exercise, a liquidity assessment review, potential liquidity assessment review, or PLAR, where we aimed at repairing the balance sheet funding mix of the banks through a combination of agreed deleveraging transactions or asset disposals, and set them certain metrics to be achieved by December 2013. We had 4 institutions in there, AIB, Bank of Ireland, ILP, and EBS, and they're currently executing PLAR plans agreed with the central bank. And we set them some key targets: loans to deposits, net stable funding ratio, liquidity coverage ratio, and those are sort of standard international banking ratios. And we're monitoring the progress to achieving these 3 targets over time. The banks have to submit a detailed point-in-time report to us every quarter, and we examine their funding ratios and compare them against the targets. In addition, the central bank and the other public authorities are interacting more regularly with the banks as they move to dispose of their non-core assets. So deleveraging at individual banks is a critical part of this restructuring process. By the end of 2013, the core components of the banks will focus on supporting the Irish economy. In the meantime, assets for disposal and deleveraging will be managed through non-core parts of the banks. And we've ensured that there's capital set aside to support that deleveraging process, those sales. But it's important to emphasize there's common cause between the central bank, the government and the banks that deleveraging should not come at any price and that fire sales should not be adopted for the deleveraging process. We therefore have to monitor this process very closely. This deleveraging process will be a long slog, but it's now starting in earnest. It will require close monitoring and perseverance with some difficult judgment calls around transaction prices. The banks themselves have the lead responsibility for ensuring progress with this process, while responsibility for ensuring value for money lies with the bank's principal shareholder, namely the government. It will be important that the non-core management teams and governance arrangements are to put in place swiftly to ensure momentum with the deleveraging process. So that's going to be quite a long process. It's going to take some years. We've talked about capital, we've talked about restructuring. I'd like to talk a bit about the refreshing of the boards and the senior management teams at the banks. So a third key work stream is improving standards of governance and fitness and probity for the financial services sector more generally, and continuing the process of refreshing the boards and management team of the banks in particular. We've learned from the banking crisis the importance of good corporate governance. As a result, we're working to develop effective corporate governance codes for the different financial services sectors. We've introduced a statutory code of corporate governance which sets out clear requirements that the directors and boards of banks and insurance companies must meet, and have set fitness and probity standards for those who work in regulated financial institutions. Our new statutory code, we think, is a balanced and proportionate approach to strengthening the governance in our banks and insurance companies, and is an important milestone in the drive to ensure high standards in the boardrooms of regulated financial firms. We made a conscious decision to impose more demanding corporate governance standards than those in place in other jurisdictions, because Ireland has suffered more than most countries in the financial crisis, and we need to get to grips with the homegrown elements of that crisis. Stronger remedies are needed here to shake up prevailing corporate governance practices and to improve the reputation of Ireland as an international financial centre. Putting a framework in place to ensure that the people operating at senior levels in regulated firms are fit and proper is also an important part of our work. Fitness and probity are the broad headings for applying standards to individuals who work or wish to work in the financial services industry in Ireland. They relate to an individual's ethics, integrity, financial soundness, but also their competence and capability. Last year, we sought new statutory powers to allow us to raise the bar in this area. We want to be able to take action where we have concerns about someone's fitness and probity to do their job. We want to have a consistent methodology applicable to all industries that would, if required, allow us to prevent individuals from entering into positions in regulated firms as a gatekeeper, if you like. When our new powers are in place later this year, we'll be able to act on fitness and probity issues. We'll have the power to carry out full investigations, and where appropriate, we'll have the ability to suspend or remove an individual from a senior position in a regulated firm. And we'll also have the power to prohibit individuals from holding senior positions in the financial services industry. The drafting of the new statutory regime means that all incumbent directors will continue in their positions and do not have to reapply under the new law. However, as you may know, the central bank plans to conduct a review of the fitness and probity of all existing executive and non-executive directors at Irish banks which have received government support. We will assess the incumbent directors against the new statutory fitness and probity standards, including, where it is relevant, their competence and track record in the period leading up to the financial crisis. We will use our new investigative powers where appropriate to ensure that the people in those positions meet the required levels of fitness and probities. I don't underestimate the legal challenges that we might have in using our new powers, but we must be prepared to make difficult judgments on fitness and probity, and it is right that we should start with this group. In the meantime, the Minister for Finance has announced that he is seeking board and management renewal plans from all the banks. He has also said that he would expect all board members, both executive and non-executive, who were in place at the time of the guarantee to step down from their posts by early next year. It's important to distinguish between the Minister's initiative and our own. Ours is a regulatory process under statutory powers to determine fitness and probity of individuals based on their track record during the period leading up to the crisis. In contrast, as I understand it, the Minister is basically saying to a class of all directors that it is in the public interest that they stand aside to refresh and renew the boards and management team of the banks to make it easier to move the banking system forward, and that this does not in itself reflect on their individual commercial or regulatory performance. This is an understandable initiative and will help provide a clean break with the past. If all those involved take up the Minister's request to act in the public interest, then there will be a smooth succession process, and obviously there should be no need to conduct our regulatory reviews. But we are gearing up to consider initiating statutory investigations if they are in fact required, in order to establish the necessary facts to make individual judgments. And going forward, the new fitness and probity framework provides a mechanism to assess the suitability of individuals who wish to re-enter the financial services system, taking account not just of track record at the banks, but also the type of role that they are seeking. Poor credit risk management practices were at the heart of the problems in the Irish banking sector, and seeking improved standards is another important work stream, the fourth I'll talk about briefly. We set out our most recent thinking in June in our banking supervision update. And while the international regulatory agenda is acting to close gaps in this area through tougher regulatory capital and liquidity standards, there's certainly an Irish dimension to the banking crisis here that requires Irish remedies as well. We're therefore contemplating a few initiatives in this area. First, we believe that there is scope to expand and develop the role of credit bureaus to assist banks, borrowers, and public authorities in managing credit risk. The absence of robust credit intelligence has led to poor decisions by lenders and has limited the ability of the central bank to monitor risk levels in the banking system. How can a bank make a good lending decision when it does not have a complete picture of the exposure profile of the loan applicant? To address this risk, we are actively participating in an interagency working group which will soon make recommendations to the Minister of Finance aimed at ensuring more robust lending decisions around credit approval, better supervision of both institutions and system-wide risk, improved consumer awareness, and increased access to credit. To give you a brief preview, the central bank would like to see mandatory and frequent reporting to the register and wants entities that provide credit registry services to be licensed and actively regulated. We'd also like to see the introduction of standard credit scoring in Ireland. Second, we think it would be helpful in December of this year to set out best practice standards on credit risk management, covering areas such as valuation, where standards were particularly weak in the bubble period. We are reviewing valuation standards for collateral, particularly for mortgages and commercial real estate loans, and investigating credit risk processes, behaviours and policies that we consider weak and that were in place prior to and during the financial crisis. We're benchmarking these against best practice, and this will help us to develop our supervisory approach. We want to put in place credit risk management standards that are appropriate for the future, and we're also reviewing the potential for applying sectoral credit limits as part of a macroprudential measure. Finally, the final work stream underway that I want to discuss involves developing and implementing a new framework for managing risk for the financial services sector as a whole as a regulator. And having a better approach to managing the risk across the population of regulated financial firms, there's some 14,200 of them, is crucial. And at the central bank, we're planning to implement a new formal risk assessment framework at the end of this year. We call this PRISM, from Probability, Risk and Impact System. And this framework is designed to allow a more structured approach to assessing firms based on the impact they will have on the economy or consumers if things go wrong, and the probability that problems arise. Now, impact and probability are important distinct concepts which combine to yield risk. As a regulator, you worry a lot about your high-impact events, even if they're low probability, because the consequences are so severe for the economy and the consumer. One of the clear organizational lessons for the central bank from the financial crisis was that we, along with many global regulators, spent too little time rigorously challenging the really high-impact firms, those firms whose failure, even if low probability, can seriously damage the economy of a country. The reports on the causes of the banking crisis in Ireland all highlight the problem of this lack of challenge, both within the central bank and the financial regulator, and also within the banks, and they all point to the need for a more structured and systematic approach to assessing risk. That means having a better way of applying resources to risk based on impact, a higher level of engagement and scrutiny with the highest impact firms taking much less on trust, a more systematic way of assessing the probability if a problem occurs, and above all, a system which obliges supervisors to follow up on risks in a conclusive manner once they've been identified, not just to keep analyzing the risk, kicking the can down the road, but say, we've got a problem, let's get a solution, let's set a deadline, and really pursue this. We're going to have to make some difficult choices, unpopular choices even, to ensure that our frontline staff can focus on the firms that really matter to Ireland. We plan to categorize all those 14,200 firms into 4 impact categories: high, medium, low, and low. And then we'll have 4 different engagement models of how much activity we have for those 4 sets of firms. For example, for the small number of the highest impact firms, we'll have a dedicated team with a proactive program of supervision and to ensure we have an intimate knowledge of the firm's strategy and business models. We'll expect firms to cooperate with this level of supervision, and we need to make judgments on their leadership and the actions of their leadership team. In contrast, for the many thousands of smaller firms, we want to use technology to help us supervise them in a more efficient way. Our objective will be to get automatic alerts based on the returns they send in for the low-impact firms if they fail key financial or consumer-related checks, so we can then follow that up. We'll not, of course, be just focused on size. Our supervisors will constantly assess the risk profile of each high-impact firm. The PRISM system will involve taking a structured approach to assessing the probability of a problem occurring by identifying the issues that could cause prudential or consumer failure. When risks exceed our risk appetite, but the probability of a problem is too high, we will require an action to mitigate that risk, to sort that risk. So making judgments and taking actions on them is very important. We will not merely work out that a firm has a problem, we importantly have to work out how to solve it. It's not just about analysis, I say, what's the mitigation plan? And we've already started this process with some of the firms, giving them a mitigation plan saying, these are the required specific actions you need to do to reduce risks and reduce the probability of risk. And our new risk system that we're bringing in will allow us to track these mitigation plans, make sure they're actually happening, deadlines aren't slipping, so we can make sure that this work has progressed. I think that's a very big point to me from the crisis. If you identify a risk, it's not just about analyze it, you want to look at it some more, you really have to say, how do you mitigate this? How do you do it conclusively within a reasonable amount of time? And can you track all the staff in the central bank to make sure that's happening and you get escalation when it isn't, so you can take tougher action if you need to. That PRISM framework is being rolled out to parts of the banking and insurance supervisory departments by the end of this year and then across the central bank next year. I'm sure it's going to take a while to bed down the new framework. It'll take some time to embed a more challenging culture within the central bank itself and to develop our understanding of the business models of the firms we supervise. We're getting pretty close to our target level of resources, but we need to continue to challenge ourselves to improve our technical skills and our understanding of the commercial drivers facing industry. So, I hope this short summary has given you a good understanding of the various developments that we believe will combine to provide for a strong, more robust banking sector subject to more effective governance and regulation. As a final observation, I note that these changes occur in the context of the wider financial services sector, where Ireland is a leading player in the funds and insurance industries and has an important international wholesale banking sector. These parts of what are loosely known as the IFSC play a crucial role in Irish economic life. However, the reputational damage of the banking crisis has cast a long shadow and has indirectly touched them too. By reforming the banking sector and strengthening financial regulation more generally, by closing gaps in governance and probity standards, implementing a new risk assessment framework, adopting forthcoming legislation on new powers, through these measures, Ireland can rebuild its reputation as a financial centre based on strong regulation. This will help avoid fresh supervisory problems in the future and will allow the IFSC to continue to prosper. So, progress on the banking agenda, while essential in its own right, has important broader benefits. There is still some way to go, but I hope I've shown you there are positive developments on a number of fronts. By the time of the next summer school or two, I would hope to not only have a few more of Donegal's hills under my belt, but also be able to report further progress with this ambitious and essential set of reforms. Thank you.